If you're exploring precious metals investing, you've probably encountered claims about silver shortages, paper market manipulation, and dire warnings about bank custody. Today, we're going to examine the actual mechanics of how banks handle silver products, what risks genuinely exist, and what questions you should ask before making any investment decisions. This isn't financial advice. I'm not a financial advisor, and you should always consult with qualified professionals before making investment decisions. But understanding how these systems work is important for anyone considering precious metals as part of their portfolio. When you buy silver through a bank, you're not always buying the same thing. There are several different products, and understanding the distinction matters. First, there's physical silver purchase with delivery. You pay the bank, they source physical silver coins or bars, and they deliver them to you or you pick them up. Once you have possession, that metal is yours. The transaction is complete. Second, there's allocated silver storage. You purchase specific, identified bars or coins that are segregated and stored in your name. These particular pieces of metal are yours, stored in a vault with serial numbers recorded. You can typically visit and inspect them, and you can request delivery. Third, there's unallocated silver accounts. This is where things get more complex. You have a claim on a certain amount of silver, but there aren't specific bars or coins set aside with your name on them. The bank pools everyone's silver together and manages it collectively. You have a contractual right to silver, but not ownership of particular physical pieces. Fourth, there are silver certificates and ETF products. These are paper instruments that track the price of silver. You don't own metal. You own a financial product whose value moves with silver prices. These distinctions matter because your rights and risks differ dramatically depending on what you actually own. When you hold physical silver in your possession, you have eliminated counterparty risk. No one can default on silver you're holding. No institution can change terms or fail to deliver what you already have. The trade-off is that you bear storage costs, security concerns, and insurance needs yourself. With allocated storage, you own specific metal, but you're dependent on the institution holding it. You need to trust their security, their record-keeping, and their continued operation. You should verify they have insurance and understand what happens if the institution faces financial difficulties. With unallocated accounts, you're essentially a creditor of the institution. You don't own metal. You own a promise to receive metal or its cash equivalent. If the institution experiences financial stress, you could face delays, cash settlement instead of metal delivery, or, in worst-case scenarios, losses if the institution becomes insolvent. This is where many investors get surprised. If you have a silver account with a bank, I strongly encourage you to read the actual terms and conditions. You'll often find clauses like these. The bank reserves the right to settle positions in cash equivalent at prevailing market prices. Physical delivery is subject to availability and may be delayed during periods of high demand. The bank may hold silver on an unallocated basis and may not maintain one-to-one backing of all customer positions at all times. These aren't hidden. They're in the agreements you sign. But many investors don't read them carefully or don't understand the implications. What these clauses mean is that during times of market stress, you might request your silver and receive a check instead. You might wait weeks or months for delivery. You might discover the bank doesn't actually have all the physical metal it's sold claims against. There are real historical examples of precious metal delivery problems, though it's important to understand them in context rather than as proof of inevitable collapse. In 2020, during pandemic market stress, some gold and silver ETFs traded at premiums to their net asset value because physical metal was difficult to transport internationally. Refineries were closed, transportation was disrupted, and the normal arbitrage mechanisms broke down temporarily. This wasn't fraud, it was logistics under extraordinary circumstances. The premiums eventually normalized as transportation resumed. In the 1970s and early 1980s, during periods of extreme precious metals demand, some dealers experienced delays in fulfilling orders. Wait times extended from days to weeks to months in some cases. Prices were volatile. Supply chains were stressed, and some smaller dealers went out of business owing metal to customers. Those with metal in hand weren't affected by these delivery problems. The Hunt Brothers situation from 1980, which many silver promoters reference, is actually a cautionary tale about leverage and speculation, not about the inherent value of physical metal. The Hunts used enormous leverage to control silver positions they couldn't actually afford. When COMEX changed margin requirements, they faced margin calls they couldn't meet. The lesson isn't buy silver before it's too late. It's understand leverage risk and don't overextend. Let me be clear about what risks genuinely exist, without exaggeration or catastrophizing. Liquidity risk in unallocated accounts. If many customers simultaneously request physical delivery from unallocated accounts, the institution may not have sufficient physical inventory on hand. They would need to source metal from the wholesale market, which could take time and might not be possible at previous prices. This is real, and it's why understanding allocated versus unallocated matters. Institutional solvency risk. If your custodian bank faces financial difficulties, your metal holdings could be frozen during bankruptcy proceedings. With allocated metal, you're typically better protected because those are identified assets held in your name, not bank assets. With unallocated accounts, you might be an unsecured creditor competing with other creditors. This is why due diligence on your custodian's financial strength matters. Cash settlement risk. Many silver products include terms allowing cash settlement. During extreme market conditions, you might want physical metal but receive cash instead. If you believe the cash price doesn't reflect true value, or if you specifically wanted metal for non-financial reasons, this could be problematic. Reading contracts before signing prevents surprises. Premium and spread risk. The difference between what you pay to acquire silver and what you receive when selling, the spread, can be substantial, especially during market volatility. Physical silver often trades at premiums to spot price, sometimes significant premiums during high demand. These costs reduce investment returns and should be factored into any analysis. However, it's important not to catastrophize. These risks don't necessarily mean the entire banking system will collapse. All paper silver claims are fraudulent. We're on the verge of total market failure. You must act immediately or face ruin. Physical possession is the only rational choice. These are investment considerations, not apocalyptic certainties. Different investors with different goals, resources, and risk tolerances will make different, reasonable decisions. If you're considering silver products through a financial institution, here are specific questions you should ask. Is this allocated or unallocated storage? Get clarity on whether you own specific identified metal or have a claim on pooled holdings. What are the terms for physical delivery? Are there minimum amounts? What are the timelines? What happens during high demand periods? Are there circumstances under which cash settlement might occur instead? Where is the metal stored? Is it in a specific vault? What jurisdiction? What security measures and insurance exist? What are all the fees? Storage fees, transaction fees, delivery fees, insurance fees? Understand the total cost of ownership. What happens if the institution faces financial difficulty? Are metals holdings segregated from institutional assets? What are your rights as a customer versus as a creditor? Can you audit or verify holdings? For allocated storage, can you inspect your metal? Are there independent audits of inventory? Practical considerations for different approaches. Let's talk practically about different approaches and their trade-offs. Physical possession at home. You have maximum control and no counterparty risk. However, you bear all security responsibility, may face insurance challenges, and have liquidity concerns when you want to sell. You need proper storage, a quality safe at minimum. You should insure it, which requires declaring value to your homeowner's insurance and understanding coverage limits. When you want to sell, you need to find a buyer willing to verify authenticity and give you a fair price. This works well for people who view silver primarily as long-term insurance against currency problems and who have the security capability to store safely. Safe deposit box at a bank. This provides security without home storage concerns, but you're dependent on bank access. During bank holidays or emergencies, you can't access your metal. After the 2008 financial crisis, there were isolated cases of banks restricting safe deposit box access during periods when banks were closed. It's rare, but possible. You also still need insurance, and banks typically don't insure safe deposit box contents. That's your responsibility. Private vault storage allocated. Companies like Brinks, Loomis, or private vault operators offer allocated storage. You own specific metal, it's professionally secured and insured, and you can visit or request delivery. Costs are higher than bank safe deposit boxes, but include proper insurance. The key is choosing an established, well-capitalized company with transparent operations. Ask about their insurance coverage, their financial backing, and their track record. Bank unallocated accounts. These typically have the lowest fees because the bank can manage inventory more efficiently. You get price exposure to silver without physical handling concerns. The trade-off is that you're exposed to bank default risk and might receive cash instead of metal during stress. This can make sense for investors who primarily want price exposure and aren't concerned about physical possession, but understand you're trusting the institution. Silver ETFs. Products like SLV, iShares Silver Trust, provide liquid exposure to silver prices tradable like stocks. They're extremely liquid. You can buy and sell instantly during market hours. However, they're explicitly not designed for physical redemption by small investors. Only large authorized participants can redeem for physical metal, and even then, the prospectus includes clauses allowing cash settlement. These work well for traders and investors wanting price exposure, not for people specifically wanting physical metal. What about the paper market collapse scenarios? You'll encounter many dramatic predictions about paper silver markets collapsing and only physical metal having value. Let's examine this rationally. The concern is based on the fact that futures markets and some silver products involve more claims on silver than physical silver immediately available for delivery. This is called fractional reserve precious metals, analogous to fractional reserve banking. This is actually normal market function, not fraud. Most futures contracts are cash settled by design. They're hedging and speculation tools, not physical delivery mechanisms. The system works as long as most participants cash settle rather than demanding delivery. Could this system experience stress? Yes, absolutely. If a large percentage of futures holders simultaneously demanded delivery, there would be delivery delays and price volatility. We've seen temporary dislocations before, particularly in 2020. Could this cause a complete market collapse where paper silver becomes worthless and only physical trades? This is far less likely. It would require not just stress, but total institutional failure, regulatory abandonment, and complete loss of market function. It's theoretically possible in a catastrophic economic collapse scenario, but at that point, you have much bigger problems than your silver allocation. The rational position is somewhere between nothing will ever go wrong and apocalypse is imminent. Stress and dislocations are possible. Delivery delays happen. Premiums can spike. But complete, permanent market failure requires catastrophic system collapse that would affect far more than just silver markets. Here's what I think represents a balanced approach to thinking about silver investment. Understand your actual goals. Are you trying to hedge inflation, protect against currency devaluation, speculate on price increases, have tangible assets for emergency scenarios? Different goals suggest different approaches. Be honest about what you're actually trying to achieve. Don't overallocate. Precious metals promoters often suggest 25%, 50%, even 100% allocation to metals. Most financial advisors suggest 5 to 10% maximum for precious metals within a diversified portfolio. There's a reason for this. Metals are volatile, produce no income, and have long periods of underperformance. They're portfolio insurance, not a complete investment strategy. If you choose physical, really commit. Don't buy physical silver and then store it poorly or without insurance. If you're going to bear the costs and inconvenience of physical ownership, do it properly. Quality, safe, adequate insurance, discreet storage location, and understanding of how to sell when the time comes. Diversify within metals if you hold significant amounts. Don't put everything in silver. Gold has different market dynamics. Consider platinum and palladium for industrial diversification. Don't put all your metals with one custodian if using vault storage. Counterparty risk applies to vaults, too. Be skeptical of urgency. If someone is telling you that you must act immediately or you'll miss the opportunity, be cautious. Precious metals have existed for thousands of years and will exist tomorrow. Artificial urgency is a sales tactic, not investment analysis. Markets have cycles. Sometimes metals outperform, sometimes they underperform. There's rarely a last chance that requires immediate action without proper research. Read the actual documents. Don't take a salesperson's word for how a product works. Read the prospectus, the terms and conditions, the custody agreement. Understand what you're actually buying, what your rights are, and what circumstances might affect those rights. Understand tax implications. In the United States, physical precious metals are typically taxed as collectibles, with a maximum 28% capital gains rate, higher than long-term capital gains rates on stocks. Some ETFs have different treatment. Some storage arrangements have reporting requirements. Consult with a tax professional about your specific situation. Here's something important that doesn't get discussed enough. Precious metals investing often has a strong emotional component that goes beyond financial analysis. There's psychological comfort in tangible assets you can hold. There's a sense of control when you have physical metal that doesn't exist in a brokered statement. There's anxiety relief for people worried about financial system stability. These emotional factors are real and valid. If owning physical silver reduces your anxiety about financial uncertainty and helps you sleep better at night, that has value, even if the pure financial return isn't optimal. Peace of mind matters. However, recognize when emotions are driving decisions. If you're buying silver primarily out of fear rather than as part of a considered investment strategy, pause and reflect. Fear-based financial decisions often lead to poor outcomes. Buying high during panic, selling low during calm, over-allocating, or choosing inappropriate products. The goal is informed decision-making that accounts for both rational analysis and emotional needs, not decision-making driven entirely by either logic or fear. As you research silver investment, watch for these warning signs that should make you cautious. Certainty about the future. Anyone claiming they know for certain that silver will reach a specific price by a specific date is either delusional or dishonest. Markets are inherently uncertain. Predictions are educated guesses at best. Apocalyptic framing. If the pitch is that civilization is collapsing and only silver will save you, be skeptical. These narratives appeal to fear and short-circuit rational analysis. Pressure tactics. Limited time offers, last chance, only X remaining at this price. These are sales tactics designed to prevent you from thinking carefully or comparing options. Promises of guaranteed returns. No investment has guaranteed returns. Anyone promising them is lying or selling something that isn't actually an investment. Lack of transparency about costs. If a dealer won't clearly disclose their premiums, fees, and spreads, shop elsewhere. Transparent pricing is a sign of legitimate business. Overly complicated structures. Sometimes complexity serves the seller, not the buyer. If you don't understand what you're buying after having it explained, don't buy it. Claims that they don't want you to know. Conspiracy framing is a red flag. Silver markets are among the most analyzed and discussed markets in the world. Information is widely available. To make truly informed decisions, consider perspectives that might contradict common precious metals narratives. Industrial demand cuts both ways. Yes, silver has industrial uses, which creates demand. But economic recessions reduce industrial demand. In 2008-2009, Silver fell from over $20 to under $9 as industrial demand collapsed. Industrial use creates demand volatility, not just demand support. Mining supply is responsive. When prices rise significantly, mining becomes more profitable and supply increases. This is basic economics. Supply isn't fixed. It responds to price signals over time. Dollar strength isn't linear. Precious metals often move inversely to the dollar. But the dollar can strengthen for extended periods during global uncertainty, flight to safety. Being early in a metals position during a years-long dollar rally can be painful. Opportunity cost matters. Money in silver isn't in stocks, bonds, real estate, or businesses. From 2011 to 2020, silver was down while stocks tripled. Diversification means accepting that some holdings will underperform while others outperform. Historical averages revert. The gold-to-silver ratio, how many ounces of silver equal 1 ounce of gold, has varied historically, but tends to revert toward long-term averages. Extreme ratios can persist longer than investors expect. These aren't arguments against silver investment. They're factors that complicate simple narratives and should inform timing and allocation decisions. If, after considering all this information, you want to explore silver investment, here are sensible first steps. Educate yourself further. Read books on precious metals investing from multiple perspectives. Understand market history, including the long periods when metals underperformed. Learn about factors that drive metals prices beyond simple supply and demand. Start small. Buy a few coins or a small bar to understand the process, the premiums, the storage considerations, and how it feels to own physical metal. Learn before committing significant capital. Compare dealers. Get quotes from multiple sources: local coin shops, online dealers, banks, and brokers. Compare premiums, shipping costs, return policies, and reputation. Check Better Business Bureau ratings and online reviews. Consider dollar-cost averaging. Instead of buying a large position all at once, consider buying smaller amounts regularly over time. This averages your entry price and removes the pressure of timing the market perfectly. Create a selling strategy. Before you buy, understand how you'll sell when the time comes. What dealers buy back?